Okay, good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're going to do a rapid fire session where we are going to go over about 10 different option strategies and go over the best practices for each one of these strategies so that you know exactly when you're using these types of strategies, what to look out for, what type of expiration dates and strike prices based on our back testing are optimized, and having an understanding as to, for some of the strategies, when you might want to take profits and cut losses. So we're going to go through a lot of different strategies. If you want to learn more about each one, you can follow some of our YouTube videos to learn more about each one. But today we're going to go through a wide variety and hopefully even introduce some new strategies that you may not have thought of using in the past. And we're going to go from beginner to advanced. Before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the securities or any of these securities that we're going to show here for today. So first, I want to talk a little bit about these types of strategies and why we want to use them to help you build confidence in your trading. And it's really just about making sure that you understand the data as to why we suggest using specific expiration dates and strike prices, because when you use these optimized strategies, that's when you know that you're not making the mistakes that a lot of the beginner traders tend to make when they're utilizing some of these strategies, because a lot of options trading is very counterintuitive. We think that if we're buying options, we should buy very short dated options. If we're selling options, we should sell longer dated options. But the research clearly shows and the data clearly shows it's the exact opposite. When we're buying, we want to buy longer dated. When we're selling, we want to sell shorter dated. And also when it comes to strike prices, buying, a lot of times we see a lot of traders will buy out of the money call options because they're very cheap. But in reality, we find that buying at the money or slightly in the money are actually the ones that give you the best overall return in the long run. And so today what we want to do is we want to show you the data behind helping you find these, finding confidence. Then we'll talk a little bit about the optimal option strategies. We'll talk a little bit about adjustment and exit strategies and income and opportunity reports that are available to you for all of these. So when we talk about gaining confidence in your trading, it's all about making sure that understanding that you can't control market direction, but what you can control are things like position sizing and your strategy selection. And when we talk about, selecting a strategy, we're going to talk through a lot of different strategies here today. And what we're going to talk about predominantly is how to utilize a probability-based approach to selecting your strike prices. Excuse me. A probability-based approach to selecting your strike prices. And this is really kind of where a lot of our research is being done in terms of how do you go about selecting your strike prices, especially when you take a delta-based approach. So for those of you that are brand new to the Greeks, it's important to understand kind of some of the basic Greeks like delta and what does that mean, because it's going to make sure that the strategies you provide have a balance between probability and risk to reward. We tend to see a lot of retail traders, what they'll do is they focus on one thing over the other. They'll focus on really high probability, or they'll focus on just risk to reward and not look at the two on balance with each other. So all of the strategies we're going to discuss here today will largely be trying to find the right balance between probability and risk reward, because these two things are always going to be opposing to each other. There's no strategy that has great probability and great risk to reward. That doesn't exist. If you have great probability, that means you have poor risk to reward. If you have great risk to reward, that means you have a low probability. So it's about finding which strategies do you want to focus more on probability, which ones do you want to focus more on risk to reward, and how do you find the balance between the two. And then what you really have to do is, even if you learn these types of strategies, you still have to know when to cut your losing positions, when to adjust your winning positions in order to be profitable in the long run. And today we're going to try to lay out some of these simple rules around taking profits and cutting losses to hopefully help avoid, having an emotional decision, because the worst thing that you can do in trading is to trade based on emotion. You want to trade based on rules that have been back tested, rules that you can have confidence in these types of rules as to why you are following them to begin with. So let's go ahead and get started. Let's look at all of the strategies here. So like I said, today what we're going to do is we're going to go from very beginner to very advanced strategy. And we're going to basically cover the full gamut. So the first option strategy that most investors, such as yourself that's watching today, how many of you are familiar with cover calls? Please type 1 into the chat window if you are familiar with cover calls, or maybe you've traded a cover call before in your portfolio. Okay, I see quite a few ones. Actually, a lot of ones now. So again, many of you are familiar with this. This is the simplest option strategy. This is really where the goal of it is to help you take profits on your equity positions. And while you wait for that to happen, what you do is you're generating an income stream. Basically, you hold the stock. Let's say AstraZeneca is currently trading at 10.59. Here I'm selling an 11.10 call option on AstraZeneca, so about 50 crowns higher than the current price. What I'm going to collect is 390 crowns by selling this call. And if AstraZeneca was to increase in value from 10.59 to 11.10, I'm going to be able to take profits on my stock. And if that doesn't happen, I keep the 390 crowns in profit, and I get to do it again and do it over and over and over again until the stock rallies up to my strike price, at which point I should be taking profits, and I get to keep all of the income I've collected up to that point, right? So this is a basic strategy. We've backtested this across every single possible expiration date and strike price. 30 to 45 days is the optimal expiration date. Whenever you're selling an option, shorter dated options will accelerate the amount of theta that you're collecting per day. That's why we sell shorter dated options. And this is really the part that's very important, that when you're selling cover calls, you want to sell cover calls that are very far away from the current price, about 10 to 15 deltas. So when you're using OptionsPlay, you can use OptionsPlay to take a look at the deltas, but deltas really tells you the probability of the stock being above the strike price at expiration. So if as you can see here, this has an $84% probability of profit. That means that's about a 15 delta, meaning if there's an 84% chance that the stock will be below 11.10, then that means there's a 15% chance the stock will be above 11.10. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Okay, the delta tells you the probability of the stock being above a specific price, especially on a call option, the probability of the stock being above that price at expiration. So that's why a 15 delta translates to roughly about an 85% chance that the stock will be below that price and you're going to keep your income. That's what probability of the call expiring worthless stands for. And the reason that we want to select strike prices that have such a low probability of the stock being above is because you want to prioritize the capital appreciation of the stock so that you have plenty of upside before the stock is called away. And it's very, very important because we see a lot of investors, they will choose 20, 30, sometimes even 40 deltas on their cover calls. And many times we see investors choose 30 and 40 deltas because there's more premium, right? Instead of collecting 390 crowns, maybe you're collecting 500 crowns, 600 crowns. But what you're giving up in exchange for that is hundreds, if not thousands of dollars, thousands of crowns of upside of the underlying stock itself. So it's really important that you prioritize the upside of the stock, because an extra, let's say you select, instead of the 11.10, you select the 10.90 strike price, right? And let's say for the 10.90 strike price, you collect 500 crowns. So you're collecting an extra 110 crowns, but what you're giving up in addition for that 110 crowns is 2,000 crowns if the stock rises above 10.90, because the difference between 11.10 and 10.90 is 20 crowns, but it's 100 shares. 100 shares times 20 crowns is 2,000 crowns. What you're giving up is 2,000 crowns in exchange for extra 110 crowns in extra income. The more you do these cover calls in the longer term, that's going to be an equation that's going to cause you to lose money in the long run, or losing money is not the right term, missing out on upside opportunity. Okay. So that's why whenever you're selecting cover calls, select cover calls with the low delta or very high strike price. And just to show you this example, I'm going to show you AstraZeneca here. Whenever you use the tool here, whenever you're selecting strike prices, next to your strike price, you're going to see the premium and you're going to see the deltas. So as you can see, the 1095s will collect 500 crowns. The 1010s will collect 280 crowns. So this is a 13 delta and this is a 21 delta. So the higher the delta, the more premium you collect, but the more upside you're giving up. And sometimes for an extra few hundred crowns, you might be giving up 2, 3, 5,000 crowns in upside. So an extra few hundred crowns is not worth giving up thousands of crowns to the upside. So that's why whenever you're selling cover calls, remember, use lower delta strike prices. Does that make sense? Please type 3 into the chat window if that makes sense to you. So I'm going to spend a little bit more time on the beginner strategies because these are the ones that you're most likely going to trade, right? As we get to the more advanced ones, I'll kind of go through them a little quicker. And what I'll talk a little quickly about is a cover call scenario, meaning once you've sold the cover call, what do you do? So generally speaking, once you've sold the cover call, the stock can either rise, it can move sideways, or it can decline. And usually when the stock rises, this is when a lot of people panic because they think to themselves, I sold, I've committed myself to selling my stock at, 11.10, right? But now the stock has rallied up to 11.10, and now I think the stock can go even higher. What have I done? I've basically collected 390 crowns and I could be potentially giving up away thousands of crowns of upside because I own the stock. So this is really where my best advice to you is hold the cover call. Don't do anything. Don't panic. Hold your cover call because when the stocks rally like this, when stocks rally like this, many times you tend to see givebacks very quickly off the back of this, because especially if you pick a cover call that's far away from the current price, that means the stock has rallied a large amount in a very short amount of time. That also means that usually that gives some type of a give back. So that's why you don't want to panic and you want to hold your position. If you need to roll your position because now there's some type of new information, you think the stock is going to, not just reach 11.10, you think it can reach 11.50, 11.60, 1200, then in that case, you can buy back your cover call and sell a new cover call. But you only want to do that in the last 2 weeks from expiration. You don't want to do it early, because if you do it early, you're locking in a loss for the first call that you've sold. And many times after you sell the second call, the stock may drop immediately, and you're not really getting the benefit as much of that second cover call. So that's why whenever you're selling these cover calls and you see the stock increase substantially very quickly, don't panic. Wait for a bit of a pullback here. Then think about rolling your position only in the last couple of weeks. If the stock trades sideways, this is pretty much your best case scenario. You hold your position until expiration, or if you want to roll early, wait until about 21 days from expiration before you roll that call early. And maybe when you roll it early, you can collect a little bit more income, but you're not going to generate a whole lot more income by rolling it early. The only time where it makes sense to roll the call early is if the stock declines. And many times if you sell your stock, let's say you sell something for 500 crowns, the rule of thumb is once you're able to buy it back for 20% of the original premium. So if you sold something for 500 crowns and it's now trading for 100 crowns. So you sold something for 500, you can buy it back for 100, which is 20% of the original premium. Then you can roll your calls early, basically buy it back for 100 crowns and try to sell an immediate cover call again. Try to collect maybe another 500 crowns, because now you've lost money on the underlying stock. And what you're trying to do is you're trying to recuperate some of those losses as quickly as possible by selling cover calls quickly. And many times you're basically capturing most of the premium in a shorter amount of time. Normally you'd have to wait towards expiration for this to happen, but because the stock has declined, you're able to take profits on the cover call quickly, and then you're able to sell another cover call. Does that make sense? Please type 4 into the chat window if that makes sense to you. Perfect. Okay. So let's move on to cash secured puts. This is the second strategy. This is, in my opinion, the most underutilized strategy by investors, because if you're thinking about buying a stock, you should think about selling a cash secured put. It allows you to buy the stock at a discount with at a lower price And even if the stock never gets executed, meaning the order never gets executed, you get to keep the premium. And many times that premium is a fair sized premium here. So the rule of thumb here is generally same thing, 30 to 45 days to expiration. But when you're selling a cash secured put, you want to use a much higher delta, a delta that is much closer, a strike price that's much closer to the current price of the stock, because what you're trying to maximize not only is the income, which gives you a discount on the purchase, but you're also wanting to maximize the chances of owning the stock, right? Because you're only selling a put option because you want to own the stock. You want the capital appreciation of the stock. So you want to increase your chances of doing that. That's why we choose a higher delta. A higher delta means a higher probability of the stock reaching your strike price in order for the strategy to be executed. So here, AstraZeneca was the same thing, 10.59. Here, instead of selling, but remember the cover call before we sold was 11.10. That's about 50 crowns above the current price of the stock. Here, we're selling a cash secured put at 10.50. So that's only about 25 crowns away from the current price, half as far away from the current price as the cover call that we're selling. Because again, we're trying to maximize the chances of us owning the stock. And as you can see, by selling a strike price close to the current price, here I'm collecting 1,075 crowns. On the cover call, we're collecting 390 crowns. Here, I'm collecting almost 3 times as much in terms of premium. So basically what I'm able to do is I'm able to purchase 100 shares of AstraZeneca at 102,425. Which is the 1035. That's the strike price that I've sold. If I purchased 100 shares of it, that would cost me 103,500 crowns. And what I do is I subtract 1,075 crowns from this value. And what that gives me is 102,425,000 crowns. And that is a discount of about 1%. Because that's exactly what I'm getting. I'm collecting 1075 off of a $103,500 purchase. And that is a 1% discount on my purchase. Now, this is a 1% discount in just 23 days, which means that if, let's say, this put option expires worthless, meaning the stock does not decline to 1035 by expiration, I keep the 1,075 and I can potentially sell another cash secured put again. Depending on where the prices are, maybe the stock has moved a little higher, so I'll choose a slightly higher strike price. But the goal here is that basically every 23 days, I can collect about 1,000 crowns waiting to buy this stock. And if I keep doing that over and over again throughout the year and I never get executed on that, I'm going to collect just on my cash a 16% yield. So even if these puts never get executed, I'm going to keep a 16% yield on my cash for selling these cash secured puts. Those are the types of returns that you can get. It's actually a fair amount of yield. And that's why I say this is one of the most underutilized strategies for investors who want to purchase stocks, is to use a cash secured put in order to do so. Does that make sense? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, now let's talk about buying some options, right? Buying options are suitable only for when you have a strong directional view, meaning you think the stock is going to make a big move to the upside or a big move to the downside. And you have to believe the stock is going to do it in a short amount of time. So this is basically a higher risk, but higher return potential type trade. And the rule of thumb here is generally to go out closer to about 60 days to expiration whenever you're buying a call or a put. And strike prices can range from anywhere from 30 to 60 deltas. So let's just look through an example here for AstraZeneca. Let's look at AstraZeneca. Let's say I think AstraZeneca will continue to move higher here. So let's say I'm looking at a December 1050 call. This is a 65 days to expiration. That's roughly the 60-day expiration that we're looking for. And as you can see, I can choose a lot of different strike prices. And I said somewhere between 30 and 60 deltas. So a 30 delta would be the 1095. As you can see, that would cost me 2,175 crowns versus a 60 delta would be the 1035s. that would cost me about 5,000 crowns. So that's generally the range of strike prices that you can buy. And you can even use OptionsPlay and compare 3 different strike prices. Maybe you want to compare the 1035, 1035 to the 10, let's say 1050 to the 10, I don't know, 95. Okay. So one cost, this is odd. This is the bid-ask price. This is the bid-ask price. And this is the bid-ask price. Oh, sorry. I know why. This is flipped. This should be 1050. This should be 1065. Okay, so 3 strategies. One costs 4,000 crowns, one costs 3,200 crowns, and one costs 2,000 crowns. And this is really where I think for most traders, you want to compare the strategies side by side and see how they perform, right? So let's say you think the stock is going to reach 1110. Notice how the most expensive option will give you a return of 48%. The at the money will give you a 36% return, and then the out of the money option will actually lose money, even though the stock rallied up to the 1110 option that you expected, because you're paying 2,000 crowns or 20 crowns for a 1095. Your break-even cost is actually 1115. So the stock has to rally substantially before the strategy is profitable. Now, some will say, well, what happens if the stock makes a big move in a short amount of time? Well, that's really where the out of the money call option will outperform if the stock makes a big move in a short amount of time. So it's important to understand how time value and the underlying stock position affects the value of your options. And you can use our P&L simulator to simulate the different comparisons between an in the money, at the money, and out of the money call option and see for yourself. If you think the stock's going to make a big move in a short amount of time, which strategy is best suited for you? If you think it's going to take a little bit more time, which strategy is best suited for you? You can use the different strategies side by side and compare them and see which one's best suited for you. But the rule of thumb here is making sure that you understand the relationship between probability and risk to reward, because these out of the money call options have very low probability versus the in the money options. But if you do get the trade right, as you can see, you have a better risk to reward, but they have low probability of profit. So it's just important to understand the relationship between these two things. Does that make sense? Please type 6 into the chat window if that makes sense to you. Perfect. Okay, now let's get into some more slightly more advanced strategies. So a vertical spread. A vertical spread is really similar to what we're doing here with the call option, but we realize that call options are expensive and they also have low probability of profit. So even if we took this call option here, the in the money call option, this has a probability of profit of only 33%. How can, but at the same time, it also risks fair amount of capital, 4,000 crowns, right? So can we improve that a little bit? And that's exactly what we're hoping to do here with the vertical spread. What we're doing here is we're still going to buy the December 1050 for 4,040 crowns, but we're also going to sell an out of the money call option against it and collect, let's say, 920 crowns. And what that does is it reduces the trade cost from 4,000 crowns to 3,100 crowns. And it also improves the probability of profit from 33% to 36%. It's not a huge improvement, but it's a small improvement. So if the stock rallies from here to, let's say, 1110, as you can see here, I made the 48% return if I just bought the call option, but the call spread, I made a 92% return because I've reduced my cost basis, which reduces my risk and reduces the amount of capital that I need to get into the trade. And it also improves my break-even costs. So as the trade goes in my favor, I start making money quicker. Not only do I make money quicker, I also make a higher return because the capital outlay of a vertical spread is less than if I just outright buy that call option. So when we talk about a vertical spread, what we're doing here is we're going out to the same 60 days to expiration. We're buying an in the money call option and we're selling an out of the money call option against it. And this is really where the break-even prices will require a smaller move before you're profitable. And by reducing your risk and reducing your capital outlay, you're going to amplify your returns if the trade is correct. And if your trade is incorrect, you actually lose less money because you laid out less capital to start with. So this is really where you start to take the advantages of buying and selling options and merging them into a single strategy. So, the first few strategies that we talked about, selling cover calls, selling cash secured puts, we talked about the benefits of selling options. Then we talked about buying calls, the benefits of buying options. And here we start to merge the best of both worlds. And everything else that we're going to talk about here today is really how do we combine buying and selling options to achieve the objectives that we believe that the markets are going to do. Does that make sense? Please type 7 into the chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about when you trade a debit spread, how do you manage them, right? And this is true for if you're buying a long call or a put, or if you're buying the debit spread that I just showed you here today. The rule of thumb here is, generally speaking, there are 2 triggers to close out a long call or a put or a debit spread. And that is either a stop loss order or a take profit order. And the stop loss order is usually placed at roughly 50% of the premium that you've paid for a debit, or if you've reached 75 to 100% of the premium paid as a take profit. So let's say I buy a call option, or let's say I buy a call debit spread, and I'm spending 10 crowns per share, so about 1,000 crowns for a full contract. What I want to do is basically, if I buy something for 10 crowns and it declines to 5 crowns, then what I've done is I've lost half of the value of what I've paid. And that is a good place to put your stop loss. Now, if I bought something for 10 crowns and it reaches, let's say, either 17.5 to 20 crowns, that means I've made somewhere between 75 and 100% of the premium I've paid. And that is where I would want to take profits at 17 to 20 crowns, which is 75 or 100% of the premium that I've paid. So those are the general rule of thumb that you should utilize when you're buying a call or a put or trading a debit spread, as to when you might want to, or where you might want to place your stop loss and your limit orders, so that you're able to take profits and take profits and cut your losses, so that you're not just holding on to a trade hoping that you should never hold these trades to expiration. You should always have some type of trigger to determine, okay, this trade did not work out as I expected to. Let me cut my losses and save some of the premium that I have left to apply to the next trade. Or if the trade is going in your favor, you don't want to just hold on to them to expiration, because the longer you hold on to it, the more time value will evaporate. So you do want to take profits at some point. So these triggers are designed to help you understand when to take profits and when to cut losses on your trade. Okay, so next, let's talk about short credit vertical spreads. So a credit vertical spread is really taking advantage of something like a short put. But when you sell a put option, it requires a lot of margin and also has a fair amount of risk. Or if you were to sell a naked call option, same thing, requires a lot of margin and has unlimited risk. So when you trade a vertical spread, what you're doing is you're still selling an at-the-money call or a put, but you don't want to take on unlimited risk and you don't want to have to lay out so much capital. So what you do is you buy in a further out of the money call option. And this gives you a risk profile similar to selling a naked call or a put, but it limits your risk and limits the amount of capital that's required to enter this trade. So whenever you're trading these types of strategies, this is really when you want to go out about no longer than 45 days to expiration. And you always want to sell an at the money call or put option and then buy a 25 delta call or put against it. And the rule of thumb here for a credit spread is that you want to try to collect 1/3 of the distance between the two strikes. So let's just go through an example here for AstraZeneca real quick. Let's say I'm bullish on AstraZeneca and I want to sell a put credit spread. So we'll go out to November 19th, which is the closest to 45 days. And as you can see here, what I'm selling is the 1050 put option, which is close to 50 delta. And then I'm buying the 1005s, which is a 26 delta. So I want to sell the 50 and buy the 25 deltas. That's kind of how I want to choose my strike prices. And as you can see here, what I'm collecting is 1,530 crowns on a credit spread that's 45 crowns wide, because the distance between 1050 and 1005, the distance between those two strike prices are 45 crowns. So let's do a little bit of math. So I'm collecting 1530 divided by 45 crowns. So I'm collecting, in this particular case, 34% of the vertical width. And remember, the minimum that we want to collect is 1/3 or 33% of the width. Here I'm collecting 34%. So this meets my criteria for a credit spread. So those are the general rules of thumb that you want to use for a credit spread. Now, once you're in a credit spread, the rules for taking profits or cutting losses are a little different than debit spreads, and they're slightly more complicated because there are 3 rules. You have a stop loss rule, you have a take profit rule, and then you have a time-based rule. So the stop loss is 50% of max gain, the profit is 100% of the max gain, and the time-based is 21 days to expiration. So here's an example. Let's say I sell a credit spread that's 20 crowns wide, and I collect 8 crowns for that credit spread. So the distance between the two strike prices is 20 crowns. I'm collecting 8 of those crowns. So if I sell something for 8 crowns and it's now dropped in value to 4 crowns, what that means is I've made 4 crowns. That's half of my max profit. Because remember, whenever you're selling something, the premium that you collect, that's your max profit. So if I collect 8 crowns, that's the most I can make on this trade. So if I make half of that, which is 4 crowns, then I've made 50% of my max profit. So if you sell something for 8 and now you can buy it back for 4, it's time to take profits on that particular trade. Conversely, if I sell something for 8 and it increases in value to 16, what that means is I've lost 8 crowns on that trade. Now, 8 crowns, when I've collected 8 crowns, is 100% of my max loss. So that's why whenever you're trading these credit spreads, you want to sell, you want to set two trades, a stop loss at 4 crowns and a take profit at 4 crowns and a stop loss at 16 crowns, because at 4 crowns, I've made 50% of my max gain. At 16, I've lost 100% of my max gain. But there's one other rule that you have to pay attention to. Sometimes you sell a credit spread and the trade gets to 21 days to expiration, but it doesn't hit your stop loss and it doesn't hit your take profit. If it reaches 21 days to expiration, you still want to close out your trade, even if you haven't hit take profit or stop loss. And this is all to avoid early assignment, because if you hold these trades to expiration, you have a much higher risk that the short 1050 put may get assigned to you. And if you get assigned on this, you're going to need 105,000 crowns in order to purchase 100 shares of AstraZeneca. And generally speaking, when we sell credit spreads, we do not want to take delivery of the physical stock. So to avoid early assignment, one of the ways to do this is to exit the trade at 21 days to expiration. So by doing so, you're going to avoid any scenarios where you're going to come across where you get where you thought you were taking a bullish trade, all of a sudden now you own 100 shares of the underlying stock. And sometimes you may not even have enough capital to buy 100 shares of that stock. So for those reasons, you want to exit these trades at 21 days to expiration. So now let's get into some of the more advanced stuff. Or actually, before I move on, does that make sense, everyone? Please type 8 into the chat window if that makes sense to you with the credit spreads. Perfect. Okay. So now let's talk about some of the more advanced strategies. Calendar spreads. Now, calendar spreads, or time spreads sound confusing and sound, a little bit more complex, but they're actually just a very small variation on a debit spread. What you're doing is you're buying a call option because you think you're bullish on an underlying stock. And instead of selling a higher call option on the same expiration, you're selling a call option on a shorter dated expiration. The concept's the same. The goal is just to collect even more premium than you would if you sold a call option on the same expiration. So for example, if let's say I was buying a call option on AstraZeneca, let's say I bought the December 1065s, right? And it's costing me $32.90. I can also at the same time sell this out of the money call option and collect, let's say 12.40, right? That'll bring my cost down. If I sold this, I'll bring in about $9.20. That'll bring down the cost of the long call by about 30% or so. But if let's say I sold the November, let's say 10 same deltas, maybe a 10.10, as you can see, I can also collect 960. So what I'm doing is I'm basically collecting 960 crowns in just a single month, then in 2 months' time. And the goal here is perhaps by November expiration, the stock is below the 11.10 call option. And now what I've done is I've collected 960 crowns on the November 11.10s. And then by the time that those expire, I can sell another December call option against my long December calls. And maybe by the time December expiration comes in, instead of collecting just 9 crowns, maybe I've collected 18 crowns in premium. So that's what a time spread allows you to do. It gives you the same benefit as a debit spread, but just by doing a shorter dated expirations, if you're able to do 2 or 3 call options before the expiration of the long call option, the goal is to collect more premium by selling shorter dated options 2 or 3 times than you can selling one longer dated single option as you can if you're trading a debit vertical spread. Does that make sense to everyone? Please type 9 into the chat window if that makes sense to you. Perfect. So the rule of thumb here is that you want to buy an option that's usually about 3 to 6 months out, right? So you're basically taking a long-term bullish view on a stock. And then what you're doing is you're selling a 1 month call option against it. And by selling a 1 month call option, let's say you buy a 3 month call and then you sell a 1 month call against it. Your expectation is that after the first month, that call might expire worthless and you might sell a second call, and then you might sell a third call by the time the long call expires. And this way, over the 3 call options or the 3 months, you're going to collect more premium than if you sold just one 3-month call option. So the rule of thumb here is that you want to buy about, an out of the money call option, an in the money call option, and then you want to sell about a 30 delta, 35 delta against the calendar spread. And for those of you that have a little bit more experience, the best or the most optimal strategy is when the front month, meaning the shorter dated option that you're selling, has a higher implied volatility than the back month, which is the longer dated option that you're buying. Because you want to buy low, implied volatility, and then you want to sell high implied volatility. So you're not always going to find that dynamic, but when you do, when the long dated implied volatilities are cheap and the short dated implied volatilities are expensive, that's going to allow you to even further bring the two in line, sell that higher dated, higher implied volatility and buy the lower implied volatility. That's going to give you, quote unquote, an even better time spread. Does that make sense? Please type 10 into the chat window if that makes sense to you. And if you want to learn more, I do have a specific video just on this one strategy alone, so you can learn more about time spreads. Next, let's talk about butterflies. And you can trade call, put, or iron butterflies. And this is a strategy that a lot of traders seem to think that butterflies are best used as a neutral strategy. But we have found that that's not really the case. It's really not a good neutral strategy because it's hard to pinpoint where the stock will be exactly 1 month from today. And it's very unlikely that the price a month from today will be the same price that it is today. So it's rarely used as a neutral strategy, or at least it's not really profitable as a neutral strategy in the long run. And it's not a particularly long-term, it's a very, very low probability of success trade. Your probability of success many times is in the 19-15% range. But as you can see, the risk to reward is extremely strong. For 410 crowns that I'm risking, I can potentially make upwards of 6 times that, 2,500 crowns. So one of the things that we have found that works somewhat well with butterflies, but again, it's still very low probability of success, is to have the tip of the butterfly to be near the 1 standard deviation move. And this is because markets are pretty efficient at pricing how far a stock can move. So if you're bullish on a stock, the markets are pretty good at estimating how far the stock is going to move in that period of time. So if you use a butterfly at the 1 standard deviation move, that is where the market is most likely to end up on if the markets are bullish. And the goal here is to make this type of really low risk, high payoff bet that if you believe, if you're right on the directional view, that the market will move roughly by the 1 standard deviation move. So here I'm using the 11:10 expiration because the November 1 standard deviation moves at around 11:10. So if I'm right on that directional view and the markets are pretty efficient at pricing how far the stock can move, in the off chance that I'm right, it's somewhat likely that I'll end up somewhere around 11:10. Now, I'm not going to get it to exactly to the penny, but maybe if I end up here or if I overshoot a little bit to the upside, I'm still going to get a pretty strong risk to reward ratio to the upside. This is a tough strategy, but this is really the only way that we have been able to backtest some success with these types of butterfly strategies. So it's really more of a directional bet than it is a neutral bet. So what you're trying to do is you're trying to sell the straddle, which is the tip of the butterfly at the expected move of the underlying expiration date. And the risk reward many times should approach kind of 5-to-1 if you do get the right view here on a type of butterfly. It's not a commonly traded strategy. It is a very advanced strategy. For those of you that are interested, especially for those of you that have a good understanding of implied volatilities and expected moves, this is one kind of low probability, low risk way to play for some kind of upside move or downside move in the markets. Okay, does that make sense? Please type 11 into the chat window if that makes sense to you. And if you've never traded butterflies, you don't intend on trading butterflies, perfectly okay. This is not necessarily a strategy that you need to look into. And lastly, I'll talk about iron condors, or put, call, and iron condors. But traditionally, iron condors are most commonly traded just because they have a lower risk of assignment on all legs. This is truly kind of your neutral strategy. This is a strategy with limited risk and generally are good for a higher implied volatility environment. And the rule of thumb here is to go out about 45 days. And what you generally want to do is you want to sell a 25 delta strangle. So you're basically selling the 25 delta call, selling the 25 delta put. So these are kind of out of the money already. This is what we call the width. And then what you want to do is you want to buy back a call or a put. That's about 10, 15 crowns wide. Generally speaking, you're basically selling 2 credit spreads. You're selling a put credit spread and a call credit spread. And when you do the 2 together, it's called an iron condor. And it benefits as long as the stock doesn't move too much higher or too much lower. As long as it stays around where it is, that's when you're going to be profitable. If it starts to make a big move, that's when you're unprofitable. So the goal here is to basically do them when you think the stock's not going to make a big move. So you want to sell iron condors when there's a high implied volatility. And the other thing is that what you can do is as the stock starts to test one side, so let's say you sell the AstraZeneca iron condor and the stock starts to rise. So you start losing money on this particular trade. What you can do is you can adjust the 2 strike prices higher. So you can adjust the untested side. And by adjusting the untested side, what you can do is you can collect more premium without putting on any more risk. So you're basically just collecting more premium by adjusting the untested side. So as the stock moves higher, you move the 2 puts higher, or if the stock moves lower, you start moving the 2 calls lower. And by doing that, you're going to collect more premium. And then hopefully by doing that, eventually as the stock maybe moves a little bit higher and then comes back, you kind of end up at a point where you're still profitable in the long run. So those are some of the things that you can do when you're trading an iron condor. And lastly, I'll leave you with a short straddle and a strangle. This is probably the most riskiest of all strategies, but it also is one of the highest probability of profit strategies. So as you can see, probability of profit 63.8%, but it does have unlimited risk. So this is the type of strategy where if, let's say, you sell an AstraZeneca straddle and the stock takes off, maybe tomorrow they have some news that they have got some new drug that solves, I don't know, the world's problems, right? And the stock jumps 1,000%. Well, you have unlimited risk to the upside if you sell a straddle. So that's the risk that you're taking. So if you are going to sell a straddle 45 days out, and generally speaking, a straddle, you want to use an at the money call or put. A strangle, you want to use about a 30 to 35 delta or so. And generally speaking, the rule of thumb is to avoid selling going into earnings. And you can also adjust the untested side. So if you sell a strangle and the stock starts to rise, what you can do is you can adjust the put strike higher, and you can turn a straddle in a strangle into a straddle, right? So as the stock drifts higher, you can also move your puts higher, or if the stock starts to drift lower, you can move your calls lower. It doesn't add any additional risk, and it simply just collects more premium and hopefully helps you adjust, your probability of success on that type of trade. So with that covers the full gamut of kind of the range of options that you can trade and the general best practices around each one. And you may not use all of them. Perhaps today opens your eyes to a couple of other strategies that you might start exploring. That's really the goal of this. We have full educational sessions on helping you learn all of these sessions. They're available at this. I'll send you a link here so that you can access all of our educational courses on these types of strategies. I'll post it into the chat window here right now for anyone who's interested in learning more about these option strategies. You can find them on our options education site, which I just posted a link into the chat window. So at this point, I want to thank everyone for taking the time out here this evening. I hope that this was helpful in giving you a rundown of just the different types of strategies that you can trade and the general best practices, so that you have a better chance of exploring these, and then hopefully pique your interest in exploring some more and watching some of the videos on the in-depth analysis of each one of these strategies on the link that I just showed you. So with that, thank you so much. If you have any questions, please type them into the chat window here, and I'll try to answer a few questions before I sign off for today. Any questions? You can type it into the chat window or the Q&A window. No questions at all from anyone? Can I update price without update the whole site? I see what you mean. At the moment, no. Basically, you have to just switch a symbol and switch back if you want to see the most up-to-date pricing. But I understand what you mean. That's not something that we can do at the moment, but that's something that we can certainly add to the list of items. Thank you so much. Which reports are available for the Nordic region? So we offer equities for Sweden, Denmark, and Finland at the moment. The only market that we don't have is Norway. In Norway, we only have the index option. We are currently looking at adding Norwegian equities, but it is traded on a different exchange than NASDAQ, which is why we currently don't have the Norwegian equities, but we do have the Norwegian equity options or equity index options. How many hours do you have to put into work until you can use those strategies? So Carl, you really should start from the beginning and work your way up, right? Start from the cover calls, start from the cash secured puts, then start buying calls, then look at debit spreads, then look at credit spreads, then look at time spreads. That's how you progress as a trader. we also have paper trading. So you can watch some of the videos on our education link on how to paper trade using options. So you can paper trade some of the basic strategies first, then start paper trading some of the more advanced strategies, and you build it one by one. These all build on top of each other. So once you understand debit spreads, time spreads will become easier to understand. It really depends on where your starting point is, Carl. If you're starting from very beginning, start with cover calls and cash secured puts. Start there. That's the most important thing for you to master first. Once you get that, then you buy calls and puts. Once you feel you've mastered that, then you can start looking at vertical spreads, but start with the first two strategies. Are your deltas and expiry criteria applicable to index options? Yes, they are. The only rule of thumb that you tend to find a little different with index options is that you may not be able to collect 1/3 of the width on a credit spread. You may not be able to collect as much premium on an index option as you do on a single stock option. Those are the only adjustments that you have to make, but the deltas are the same. Can I access previous videos somewhere? Yes, the link that I just posted into the chat window, which I will post here once again, all of our previously recorded sessions are available on that website. When I have an options position, I think my broker will freeze cash or equities in my account as security. This must be kind of a cost for me as long as I have my options position. Is this negligible? So Carl, I guess it depends on what kind of options position you have, right? So if you're buying an option, whatever the cost of that option, that's going to be taken out of your account. If you're selling an option, yes, there's going to be a margin requirement to sell. That's in addition to the premium that you collect, but it's to protect the broker so that to make sure that you have enough cash on hand to settle the transaction if the trade goes in the opposite direction that you expect it to. I have a question about realizing gains after cover calls past 50%. You said to immediately sell another cover call against your long call or a long stock or call. But if we assume we sold the cover call at its lows, isn't it better to wait for a better re-entry? Jacob, not necessarily, right? So you can wait for the rebound, but what you're doing is you're also adjusting the strike prices based on where the current price. And this is really where the probability-based approach comes into play, because we're not selling cover calls based on an absolute price. We're selling cover calls specifically based on probability. So no matter where the markets are, whether it's the market just had a rise or a fall, we're trying to sell a strike price that has a 15% probability of the stock being above those strike prices. And especially after the stock falls, implied volatilities will be larger. So what was 15%, what had a 15% probability when the stock was higher is going to be closer than after the stock drops, implied volatility is higher. So we're naturally going to select a strike price that it's even further away. So, implied volatility already naturally adjusts for these things that you're referring to. So you don't have to be tactical because, if you wait, the question is, what do you wait for? What's the new signal to sell? And there isn't a really good one, and you're going to miss out on premium while you wait. So the point is that by waiting, you're going to be missing out on premium. Maybe you get in at a better position, but you're missing out on premium. And what you don't want to miss out on is premium. So don't wait, sell cover calls immediately after, and continue to use a probability-based approach, because that's how you're going to stay consistent with your cover calls. Carl, thank you so much. I really appreciate that. I hope you have a great day as well. Any other questions? Jacob, you're welcome as well. If there are no other questions, I just want to thank everyone for taking the time out here this afternoon or this evening. I hope this was helpful in giving you a better understanding as to, the variety of option strategies that you have at your disposal. I'll send you the slides so that you can review them and kind of have this as a cheat sheet that you can reference whenever you're trading any of these strategies. And 2 weeks from time, we're going to do another market outlook session. We'll look at where the markets are. We're going to review some of the trades that we put on 2 weeks ago. So please join us, especially if you're new and you're trying to get understanding as to how to get started. Joining us on those market outlook sessions are a great way to look for some real examples. We do some paper trades together and we review them 4 weeks later and see how they've been performing. It's a great way to learn. So with that, thank you so much. Have a great evening, and I'll see you guys here in 2 weeks' time on our next options education session. Have a great night.